Intraday trading is the practice of buying and selling financial instruments within the same trading day to profit from short-term price movements. Unlike long-term investors who hold assets for years, intraday traders aim to close all positions before the market bell rings at the end of the day. One primary goal is eliminating overnight risk. Because no positions are held overnight, a sudden market shift won't impact their portfolio while they sleep. Traders rely heavily on technical charts and volume data to spot trends, often executing dozens of trades in a single session. While investors look for companies with long-term potential, intraday traders are mostly interested in the short-term supply and demand dynamics of the market. Holding times vary, but intraday trading sits at the very short end of the spectrum, usually measured in minutes or hours rather than days. This classic warning highlights the high risk involved in short-term trading, where market movements can quickly outpace a trader's capital. Trading requires significant discipline and risk management. Always research thoroughly before participating. Thanks for watching, and remember to subscribe for more finance basics.